So again, welcome you all. This is Dr. Anil Tiwari, Faculty of Accounting and Finance from the Sage University Bhopal. Again, I'm here. I'm in front of you on this YouTube channel. So today, what the topic I'm going to cover for the students of commerce and management, I'm going to explain you the very important topic in the area of the managing cost. Or the topic is, you know very well, the marginal cost. You know very well, this marginal costing, now each and every time, either we are studying the economics or either we are studying the cost, always it comes into the picture. Or where we have to insert some additional unit of cost. Mhm. This topic adjusts or this topic's automatic comes in the picture. So today I'm going to tell you what the means of the marginal costing and how it could be effective for the, we can say, the business for taking the various kinds of decisions related with the cost. So again, you know very well, this is you, Dr. Anil Kumar Tiwari. I have over 13-year experience in this regard or in this particular field. So I'm going to explain you the means of marginal cost. Now see, the cost, if you talk about the cost now it can be three kinds or three types. What are the three types? The variable cost, or either it is known as the semi-variable cost or fixed cost. So variable cost, as name is, we can say, suggested, the variable, it means it is fluctuating or it is vary as the unit of production now raise or as the any unit of production increase or decrease, this cost is also vary with that particular unit or the same proportionate. That is the cost and the variable cost have a direct relation. If the cost or if the we can say the production will rise, this cost will incur more, and production will low, this cost will be a less. So this is the direct relationship variable cost and production. The semi is semi-variable. Some cost it is the some part of that cost is variable or some part of the cost is the fixed. For example, either the electricity, either you are using or not using the electricity, you have to pay the cost or the charges of this particular electricity or the meter and all. So this is a fixed thing, and as you started to use and consumption the units, the cost will be raised. So on the basis of that, now we can say the some fixed the cost are the fixed at the particular certain level and the business according to the requirement or when it can be a variable. So this is known as the semi-variable. It means it is the we can say the it is the we can say the composition of the fixed and variable, or it is the combined cost of fixed and variable become the semi-variable. So that's some part of the vary or some part. The second cost is a very simple, it is a fixed cost. The fixed cost is a variable. The cost will be a fixed at a certain level of production. It means now you structure the, we can say the factory, or you started to design, or you started to, we can say the set up your factories for the 60,000 units. So this factory will able to produce the 60,000. If you want to be a produce more than 1 lakh and more than that, so you need to be set up the another factory or you need to be invest the another fixed cost. So the fixed cost will be very. Till the 60,000 units, this cost will be a fixed. The fixed cost now is always fixed in the, we can say the business at the certain level of the production. Now, already you can see, already I taught you these things. It depends of variable cost. It means depends on production, or the semi-variable is a partly and is partly variable, partly fixed and partly variable, and that does not depend upon the production. The under the fixed variable cost, what the things comes that is it is known as direct material, direct labor, or direct expenses. Under the semi-variable cost, what comes the electricity bill, or either the telephone charges, or either under the fixed cost, what comes the rent and different kinds of expenses which we incurred as a fixed. Second, now we are going to discuss the marginal costing is what is the marginal costing? The marginal costing is the technique to estimate the incremental cost of incremental production. What the additional number of units now going to be produced, what the cost incurred on that additional unit known as marginal cost. So sometimes people say the additional cost of unit is known as marginal cost, or it is known as the sometimes people say the variable cost, because variable cost it is a vary with the production. So the individual cost, additional cost, what the vary, it becomes the marginal, or what the increment add on the earlier cost because of this increase the production, it becomes the incremental cost. So similarly, you can see there how we can calculate it. Just see the variable cost. The sales is the variable. The what the amount are you going to be sale, or the we can what we can say the revenue what will be generated. It is known as the sale. And here you will minus the fixed cost, or then you will get the contribution, and then you can minus the fixed cost. You will get the net profit. So this is the income statement. And now you can see the formula how we can calculate of the break-even points. The break-even point can be calculated by the fixed cost on the PV ratio. So, what the means of this break-even point for the PV ratio? I will teach you in my next one. The second, the profit volume ratio, how we can calculate the contribution upon the sales. The contribution already we know very well from which things it will come after the sales minus variable. It is known as the contribution. Now it will be divided by the sales. You will get the BEP. And break-even points in units, fixed cost, and the contribution per unit. And the estimated sales equal to, if you want to find out what could be a estimated sale on that particular profit. So the fixed cost is this, and the plus expected profit what you want to be on, and the contribution per unit you will divide by the contribution per unit. You will get the units which you have to be saved for on that expected profit. So this is the second is the sale estimated in the rupees, the fixed cost plus expected profit divided by the PV ratio. The marginal of safety units, it is known as estimated sales or minus the BEP. So it will get the margin of safety, or other marginal safety in the rupees. So when the ES or minus BEP in the rupees, or what the unit comes after the deducting, you can say the ES in the BEP, you can multiply by selling price. You will get the margin of safety in the rupees. And the secondly, in a margin of safety in the rupees, so we can calculate by the net profit by divided by the PV ratio. And the PV ratio equal to, very well, sometimes now we have a profit of the 2 years, or we have a sales or revenue of the 2 years. By using this 2 years sales and profit, we can calculate the PV ratio different in the profit. Differentiate what are difference in the profit of 2 years. We write first and divide by the what is different in the sales, and multiply by 100. We can find out the PV ratio. Thank you all of you to listening me with questions. In the next video, we'll discuss all the things with the numericals, so you all are able to be understand what the means of this how we can use these various kinds of formula into the practical, or into the we can say the numerical form, or how we can implement all this, or on the basis of that how we can take the decisions. So I will teach you in the next video. So thank you all of you for listening me.